Everyone is talking about Bitcoin, but quietly, something much bigger is being built in the background. We are not just heading into another crypto cycle, we are heading into a tokenization supercycle that could reshape how global markets work. And Tom Lee thinks Ethereum is right at the center of it. Through Bitmine, he already owns around 3% of the Ethereum supply and is targeting 5%. That is not a short-term trade. That is a structural bet on where the world is going. In this video, we are going to break down his thesis in 4 parts using clips from his latest interview. We will look at why stablecoins are this cycle's Bretton Woods moment, why Ethereum looks broken now but is not, how Wall Street ends up building on smart contract platforms, and what Tom's price targets really are for Ethereum over the next year. If you enjoy this kind of deep dive into macro and crypto, make sure you subscribe to the channel so you do not miss the next breakdown. Let's start with the foundation. Tom thinks what is happening with stablecoins today rhymes directly with the moment the dollar left the gold standard. Before we talk about Ethereum, we need to understand the scale of the shift Tom is comparing this to. In 1971, the dollar stopped being redeemable for gold. On paper, that should have weakened it. In reality, Wall Street built an entirely new stack of products around it and locked it in as the dominant reserve asset. Tom believes stablecoins and tokenized dollars are the modern version of that break. Once the dollar moves on chain, it becomes the template for everything else to follow. Here is how he explains that parallel.
For the listeners, in 1971 was when the U.S. formally withdrew from the gold standard, meaning the dollar was no longer redeemable for gold. And from that point forward, the U.S. and other countries, not every country went off the gold standard, basically said that from this point forward, a dollar is only exchangeable for another dollar. Okay, so the dollar became essentially synthetic relative to gold. And in 1971, many investors correctly bought gold because they said, well, that's the original store value. However, the second reality is that we had to suddenly protect the dollar to make sure it was going to be the world's reserve currency, because if that was no longer exchangeable for gold, then a country that was still in the gold standard could become the new reserve currency. So what happened? Wall Street built a bunch of new products to make sure that the dollar became the accepted standard. And over that ensuing 10-year period, it was money market funds were created, CDs, futures, ETFs, and it was successful because the dollar remained the global reserve currency. And today, it's now 80% of all financial trading pairs. In 2025, there is a similar evolution taking place, and it really started with stablecoins, which is that the dollar, which was already now synthetic, became tokenized on the blockchain. So now the dollar is now digitally represented, and that's what a stablecoin is, because it's backed by treasuries, but it's still basically just a digital dollar. That is going to be creating the roadmap for a lot of other assets to become digital, tokenized on a blockchain. And it's a big deal. We know that in crypto, for instance, the projects that have actually emerged from as native blockchain products have actually been better mousetraps. And that's something that is driving and sending Wall Street to build. The first of these has been the stablecoin and Tether. And Tether, as an entity now, it's valued, and they're raising at what is reported to be $500 billion. That would make it the second most valuable bank in the world. And even if it ends up raising at 400 billion or 300, whatever that number is, they're still the second most valuable bank in the world after JP Morgan, which is 869 billion. So a company that has today maybe 300 full-time equivalent employees is almost as valuable as a bank like JP Morgan has 313,000 employees. So there's a lot happening. There's a lot of benefits that come from tokenization, and I think that that's the big unlock that's coming.
What Tom is saying there is that the dollar went from hard, backed, to synthetic, and Wall Street responded by inventing the financial plumbing that kept it in charge. Money market funds, CDS, futures, ETFs, they all helped defend the dollar's role even after it left gold. Stablecoins do the same thing in a digital context. They take that synthetic dollar and put it on a blockchain as a programmable instrument. It is still backed by treasuries, but now it can move 24/7 settle instantly, and plug directly into DeFi and exchanges. Look at Tether as a signal: a few hundred employees, potentially hundreds of billions in value, and a footprint that rivals major banks. That is what happens when you get the architecture right in a native digital system. Tom's key point is that stablecoins are not the final destination, they are the on-ramp that proves tokenization works at scale. Once you can tokenize dollars, you can tokenize bonds, equities, credit, and more. That is what he calls the big unlock. And the obvious question from there is simple. If the future looks that big, why does Ethereum feel so weak right now? On the chart, Ethereum does not look like the backbone of a financial revolution. It looks like a volatile asset that has sold off hard and lost the market's attention. At the same time, Tom has already talked about Ethereum entering a supercycle and has put out aggressive upside targets. So how does he reconcile a long-term tokenization boom with short-term pain and a possible move lower? Here is his answer.
Why are we trading as we're trading right now with Ethereum?
Yeah. Well, Ethereum and Bitcoin are public tokens. And so their price isn't going to be purely anchored on fundamentals. They're going to be reflecting investors' perceptions, because both Bitcoin and Ethereum are not mature platforms. Their best utility and growth and innovation are in the years ahead, right? So we're 10 years in, but there's more growth in the future. The percentage of market share of crypto of total assets is so small that we know that mathematically that's true. Whenever when you have something that has a hyper growth on ramp and you're discounting the future, it's going to be very volatile. So does Ethereum's price going from 4,800 to 2,800, I mean, that is a staggering decline, but that probably is a minor change in 2030 fundamentals that is being priced and repriced by investors. And that's why there's hyper volatility. It's one reason why Bitmine ended up engaging Tom DeMark as a strategic advisor, because he is the king of sort of price discovery. He is the father of systematic timing. And in our conversations, when he looks at Ethereum, he sees what looks like engineered or systematic liquidation taking place. So there is someone that is in crypto, we know it's market makers play a big role, but there's someone that is probably capital constrained and is therefore bleeding or having to sell reflexively as price falls. That process is painful, but in his sort of rough timing range, his downside target, and we talked about this a few weeks ago, was 2,500 for ETH. So I think we're so close to that. It would be ideal actually for us to actually bleed to that level, because then that is creating what he calls a buy setup. A bottom in prices for him is when the last seller has sold, so that a stock or crypto no longer falls on bad news. I mean, that's what he thinks makes a bottom.
Tom frames Ethereum as a hyper-growth asset where most of the real value is still in the future. When you are discounting 2030 or 2035 into today's price, small changes in assumptions create huge swings. A move from 4,800 to under 3,000 feels like a disaster, but in that framework, it can be a relatively minor adjustment in long-term expectations. He also makes it clear this sell-off is not just sentiment drifting lower. Working with Tom DeMark, he sees signs of engineered or systematic liquidation, someone large, capital constrained, forced to sell as price falls. That is exactly the kind of flow that feels awful in real time, but eventually creates durable bottoms. DeMark's idea of a true bottom is simple. When there are no sellers left, price stops reacting to bad news. Tom puts the rough downside target around $2,500. He actually thinks it would be healthier for Ethereum to bleed into that zone and then stabilize, because that would mark the end of forced liquidation and the start of a real base. So short term, he accepts more pain as possible. But in his mind, that sits on top of a much bigger structural story that has not changed. To understand why he is willing to look through that volatility, you have to see how he differentiates Bitcoin from Ethereum and why he thinks Wall Street will end up building on smart contract platforms. Bitcoin's job is now clear for most investors. It is digital gold. It stores value. It moves value. That role is accepted in a way it was not 6 or 7 years ago. Ethereum's job is different. If you want to rebuild Wall Street on-chain, you do not just need a vault. You need an operating system that can store value, store information, run logic, and restructure products. Tom thinks that is where Ethereum comes in. From tokenizing stocks to factoring specific parts of a company's story into separate claims, you need a smart contract platform with real network effects. Here is how he explains that.
Even as gold gets tokenized, which I think will compete with Bitcoin to an extent, you still have Bitcoin, which is a really good way to store and transfer value. But Wall Street is also understanding there are a lot of virtues to a blockchain, and it's the ability to not only store value, but to store information and to actually transact and conduct and actually re-architect almost everything that Wall Street does. But they need a smart contract platform. And so that's where all these other L1s start to become a lot more important to Wall Street's future. Because if the big banks, the blue chips, build stablecoins and they're going to tokenize stocks and let stocks trade 24/7, and then innovate that too, which I discussed at the Cantor, which is like things like factorize a stock. So no, just like in the bond market where you can factor a bond, we can factor Tesla so that you're only buying the implied future value of Optimus Prime. So instead of asking Tesla to make itself a tracking stock, you can synthetically create that on the blockchain. So you can't really do that on Bitcoin. So you have to build it on a smart contract, L1 or L2. And the reason I think Ethereum is going to be one of the leading platforms is, number one, its sheer size. It is by far much bigger than the number 2 or number 3 L1s. It has a huge and growing developer community that is really dedicated, and it's global. So I think it's a true, robust community with actual known values, and it's a neutral blockchain with 100% uptime. So I think that this becomes one place where it's going to be easier for people to create innovative products. So for instance, let's say JP Morgan or Goldman want to just do tokenized stocks in 24/7. And they want to control as much of that as they want, as they can on a blockchain, because you lose a bit of control. They may not necessarily say they want to do a lot of this on Ethereum, but then someone's going to come along and create a product that does do this, and it's supported by a community, and then it gathers all the liquidity. That's exactly what happened with something like PolyMarket, right? On a prediction market basis, where it came natively out of the blockchain and today broke out into the real world and is, look, it's the most cited way to actually understand events in the future. I mean, it's the PolyMarket is the closest to having a crystal ball today. Like, it is the closest to tomorrow's newspaper, and it's a native blockchain product. It didn't come out of an existing Wall Street desk that created this product. It was created by builders.
There are a few important points in that clip. First, Wall Street does not just want to move existing products onto faster rails. It wants to innovate. Tokenized stocks trading 24 hours a day, 7 days a week. Synthetic ways to own only the value of something like Tesla's Optimus line without needing a new tracking stock. All of that requires programmable money. You cannot do that on Bitcoin's base layer. You need L1 and L2 platforms built for computation. And Ethereum is the largest, most battle-tested option, with a neutral design and a global developer base. Second, the most powerful products are not being designed inside bank conference rooms. They emerge natively from crypto. PolyMarket is the perfect example. It started as a blockchain prediction market and is now treated as one of the best ways to read real-world odds. That pattern matters because it shows how value will likely accrue. Native builders ship the first killer apps. Liquidity grows on those platforms. Then institutions follow, not because they are in love with the tech, but because that is where price discovery and volume are. Tom's view is that Ethereum does not need to be the only winner. There will be room for other chains. But the clearest roadmap he sees for tokenized Wall Street products, prediction markets, and new structures sits on Ethereum. On top of that, a new capital markets layer is emerging around these chains. DATs, digital asset treasuries, are becoming the wrappers that let public markets express long-term bets on these networks, and Bitmine is Tom's main vehicle for Ethereum. That takes us to how this fits into macro DAT valuations and his actual Ethereum price targets. Right now, sentiment feels terrible. DATs are trading below the value of their underlying holdings. Retail has been wiped out in multiple crashes. Many investors feel like they are stuck in yet another fake out. At the same time, regulation is improving, institutions are coming back, and macro is quietly shifting. Tom thinks this gap between how things feel and how things are setting up is where the opportunity sits. He explains how the Fed, sentiment, and Ethereum's price all intersect, and he gives his concrete targets.
I think the Fed is in a very difficult spot because if there wasn't what looks to be as political interference, I think the Fed would be cutting without question now, because bond market is showing future inflation expectations are falling, and that means that if monetary policy doesn't adjust, its real rates are getting tighter. We're actually putting more tightening into the economy. But as you know, the Fed has to make sure its actions don't look like they've been politically driven.
Yeah.
And that, not just the market's perception, right? Because people tend to think of it as, oh, well, this is the bond market or stock market's conclusion. That's not really what I think that what the Fed's concerned about. It's really the integrity of the organization. They have 30,000 or more employees, and each of them is seeing this relentless attack from the White House. So I think to the extent that the Fed governors and the voting members know that it's the morale of the institution that's at stake. So this is why the Fed is even more guarded in their actions and much more deliberate in their messaging, because they don't want anything they do to look politically motivated. And unfortunately, that's been bad for markets, because the markets have interpreted that as the Fed is hawkish. And I mean, they do sound hawkish. So I think it means that there's going to be an alignment in later months when inflation is fallen enough and the Fed can now make cuts where it's no longer viewed as politically motivated.
Right. So you need a little more overhead cover. Awesome. Really appreciate it. Any last thoughts, Tom, before we let you go and get back after it?
Well, it's just I think for anyone who's involved in crypto for a long time knows this, and so there's many who are new, but crypto has declines, and we're not necessarily in a bear market, and it feels terrible. In fact, that's what you have to be mindful of, is that it's a hyper volatile space, so it feels terrible now. But just like in 2024, crypto felt terrible for many months, and then we've had these big moves.
Yeah, you have the meltdown, then you have the melt up. Volatility works in both directions. Before I let you go, any price targets for ETH?
Yeah, I think, well, in the near term, there is downside, maybe to 2,500, but that's minor compared to the upside of trying to discount a super cycle. So we think ETH can be 7,000, 9,000 by the end of January, and that's a huge recovery move, but that's also pretty typical of what could happen in the fourth quarter.
Tom is clear that crypto reacts early to the Fed. If policy stays too tight for too long, you get pressure on all risk assets, and crypto sniffs it out first. Right now, bond markets are telling you inflation expectations are falling. In a normal world, that would justify rate cuts. Instead, the Fed is moving slowly because it does not want to look politically driven. That caution effectively tightens real rates in the short term and weighs on markets. Tom does not think that lasts. He expects an eventual alignment where inflation is low enough, the political noise is reduced enough, and the Fed can finally ease without looking like it is serving the White House. That is where he sees the next big move. In the near term, he still sees risk down toward that $2,500 zone on Ethereum. But compared to the upside he is focused on, that drawdown is small. His view is that if we are indeed entering an Ethereum supercycle tied to tokenization, stablecoins, and institutional adoption, Ethereum can trade in the $7,000 to $9,000 range by the end of January. On top of that, he has already talked about a long-term structural target around $60,000 if Ethereum truly becomes a core settlement layer for tokenized global markets. So the picture looks like this. Short-term, volatility, forced selling, and possibly one more leg down. Medium-term, a violent recovery into the high single-digit thousands once macro and flows line up. Long-term, a full tokenization supercycle, where Ethereum is one of the main operating systems for global finance. To pull it all together, in 1971, the dollar left gold and Wall Street built the products that kept it on top. Today, stablecoins are doing the same thing for a digital dollar, and they are opening the door for everything else to be tokenized. Tom Lee thinks Ethereum is at the center of that shift. It is the smart contract platform with the size, developers, and neutrality to host the next generation of financial products. DATs like Bitmine are the capital markets wrappers that let institutions express that bet at scale. Right now, the charts look ugly and sentiment feels awful. But in Tom's view, that is exactly what the base of a supercycle looks like. Prices are weak, structure is building, and almost nobody believes the upside. If he is right, the real tokenization wave has not even started yet. And Ethereum is about to move from interesting smart contract chain to core infrastructure for global markets.